We're about to uncover a shocking revelation that could shake the very foundations of the global economy. This financial bombshell has gone unnoticed by most Americans, and it's all about to come crumbling down like a pile of cards. As it stands, 4 Wall Street megabanks are currently holding a staggering $3.3 trillion in uninsured deposits. That's right. Not only are these deposits not covered by the FDIC, but they've also become a significant risk to the stability of the entire banking system. In this video, we've detailed how this situation came to be and what it means for you and me. Ready? Let's dive in. As you stroll through any bustling American city, you'll come across the towering buildings of the Big Four banks: JP Chase, Bank of America, Wells Fargo, and Citigroup. These banks are not only colossal in size, but also in their influence over the nation's banking industry. With their combined assets surpassing $1 trillion, in fact, they are as ubiquitous as gas stations, with a branch seemingly on every other corner. In the wake of the failures of Silicon Valley Bank and other smaller regional banks, many depositors have grown increasingly anxious about the safety of their funds. In response, they've rushed to move their money to the national banks, believing that their size and national reach provide greater security. After all, if one of these too-big-to-fail banks were to go under, the government would intervene to prevent a catastrophic financial meltdown, ensuring that even uninsured deposits are protected. But is this sense of security warranted? And just how true is this notion of safety? The FDIC's chair, the regulatory agency that safeguards U.S. bank deposits and insurance programs, recently testified before the Senate Banking Committee. During the hearing, concerns were repeatedly raised about the risk posed by the Big Four banks holding vast amounts of uninsured deposits, raising questions about the security of the U.S. banking system. Silicon Valley Bank and Signature Bank may have represented the second and third largest bank failures in U.S. history, but in the grand scheme of things, they were mere minnows compared to the colossal whale banks on Wall Street. These giant banks are so enormous that their deposit exposures are in the trillions, making it difficult to comprehend just how much money they handle on a daily basis. For context, Silicon Valley Bank, which held $175 billion in deposits as of December 31st, 2022, is dwarfed by JP Chase Bank N.A., which held a staggering $2.015 trillion in deposits in domestic offices, of which $1.058 trillion were uninsured. Similarly, Bank of America held $1.9 trillion in deposits in domestic offices, of which $909.26 billion were uninsured. In comparison, Wells Fargo held $1.4 trillion in deposits in domestic offices, of which $721.1 billion were uninsured. But perhaps the most eye-opening detail was about Citibank N.A., which held $777 billion in deposits in domestic offices, of which $598.2 billion were uninsured. But it doesn't end here. Citibank also held an unbelievable $622.607 billion in deposits in foreign offices, of which potentially none were insured, according to current law and rulemaking. This would bring the total deposits at Citibank in domestic and foreign offices to $1.4 trillion. Potentially only $178.8 billion are FDIC insured, which amounts to a mere 13% of their total deposits. So it's not just the size of these banks that is mind-boggling, but also the sheer volume of transactions they handle daily. But Citibank especially has a reputation for consistently engaging in reckless business practices that put taxpayers in a vulnerable position. For context, while the financial crisis of 2008 was a devastating period for the United States, Citigroup's reckless behavior at the time likewise only added to the chaos. As noted by Sheila Bair, the chair of the FDIC during the 2008 financial crisis, in her 2012 book, Bull by the Horns, despite receiving trillions of dollars in revolving loans and capital infusions to keep it afloat during the financial crisis from 2007 to 2010, Citibank only held a mere $125 billion in U.S. insured deposits, and the situation could have been much worse had foreign depositors, who comprised the bulk of Citibank's depositors, decided to withdraw their funds in the event of a Citigroup collapse. Many of these depositors were either not insured or had low insurance amounts. The FDIC could have dealt with a $125 billion problem had only U.S. insured deposits been involved. Still, the financial system would have faced a colossal $2 trillion problem on Citigroup's books and an additional $1 trillion off the books. To put this into perspective, the total derivative counterparty agreements would also amount to trillions of dollars, adding to the complexity of the situation. And as it stands, American banks still trade billions of dollars worth of securities, currencies, and derivatives every day, and the risk exposure is still so vast. By implication, the potential losses these banks could face in the event of a financial crisis are staggering, and the repercussions could be felt across the entire economy. As of December 31st, 2022, the Deposit Insurance Fund, DIF, had reached an all-time high of $128.2 billion, a positive sign for the FDIC and depositors, with a total of $17.7 trillion in domestic deposits. The FDIC has protected many individuals and entities. However, it's worth noting that the FDIC only guarantees deposits of up to $250,000 per person per bank. Interestingly, the $250,000 deposit insurance limit was only established by the 2010 Dodd-Frank reform law in response to the 2008 financial crisis. This law was put in place to restore confidence in the banking system and protect depositors in the event of bank failures. But despite this protection, accounts exceeding the $250,000 limit mainly belong to entities that require a lot of cash on hand, such as small businesses, nonprofits, or municipal governments. Additionally, the FDIC does not protect other investments like stocks, annuities, and mutual funds. This means that depositors with these types of investments may need to consider other forms of protection to safeguard their assets. It's also worth noting that more than $9.2 trillion of U.S. bank deposits were uninsured at the end of last year, accounting for over 40% of all deposits, according to U.S. central bank data. This also highlights the need for Americans to carefully consider protecting their funds and spread them across multiple accounts and institutions. The collapse of SVB on March 10th especially sparked concerns over protecting small business clients' deposits. At the time of its collapse, 89% of SVB's $175 billion worth of deposits were uninsured, implying that the potential loss of these funds could significantly impact the affected business's ability to pay their staff. This and similar case scenarios, as witnessed by the collapse of Signature Bank, have underscored the importance of depositors being aware of the protection provided by the FDIC and taking measures to protect their funds accordingly. Due to these recent occurrences in the U.S. banking industry, banks are now on even higher alert, constantly assessing and managing various risks that could jeopardize their financial stability. But their most significant risk still comes from uninsured deposits, which can create a dangerous situation for banks as account holders become more sensitive to bad news and quickly move their funds to protect themselves. This behavior could potentially drain a bank's funds when it's in dire need of cash flow. So while banks are typically backed by the FDIC to protect account holders against losses, there are limits to how much the FDIC can insure. And as a result, some account holders may choose to keep their funds uninsured, either because they exceed the insurance limit or because they want to keep their money outside the banking system. This behavior can create a dangerous situation for banks, especially if they're already struggling financially. Now, the recent events in America's banking industry have not only sent shockwaves through the U.S. banking system, it's also made regulators realize that immediate action was necessary to prevent a larger crisis. So in addition to the FDIC, officials from the Treasury Department and the Federal Reserve have been involved in the decision-making process to calm the present storm, working around the clock to devise a plan to stabilize the situation. One of the key challenges they faced was handling depositors whose accounts exceeded the $250,000 limit, usually protected by FDIC insurance. In the end, they decided to use a systemic risk exception to extend coverage to all SVB and Signature Bank depositors, regardless of the amount they had in their accounts. This was a highly unusual move requiring significant coordination among different agencies and financial institutions. The FDIC would be responsible for reimbursing depositors for their losses, but any funds needed to cover those losses would be raised through a special assessment of other banks. For context, a group of top-tier financial institutions have announced their plan to inject $30 billion into First Republic Bank, indicating their unwavering confidence in the banking system. The deposits must remain in the First Republic Bank for at least 120 days, further bolstering the bank's balance sheet. This move by the banks is expected to have a ripple effect on the industry. It's a clear signal that the country's top financial institutions have faith in the smaller banks' abilities to provide excellent services to their clients. It similarly shows a united front of support for the banking sector as a whole, which is crucial in these trying times. But despite the urgency of the situation, officials were careful to emphasize that the government was not providing a blank guarantee for all bank deposits. Janet Yellen, the Treasury Secretary, further clarified this point during a congressional hearing when she emphasized that future failures must pose similar risks to the banking system before the systemic risk exception could be used again. Similarly, in light of recent collapses such as SVB and Signature Bank, some lawmakers have suggested that Congress should consider increasing the federal insurance limit on bank deposits. However, this would require legislative action, which can be challenging in a divided Congress, particularly in an election year. One potential consequence of a higher federal insurance limit could be increased consumer confidence in the banking system. Account holders would feel more secure in their deposits, which could lead to increased savings and investments in the economy. But on the other hand, critics argue that higher insurance limits could incentivize banks to take greater risks, knowing that the government is ultimately responsible for covering losses if things go south. The decision on whether to increase a federal insurance limit on bank deposits is complex, with many factors to consider. It will ultimately be up to Congress to determine the best course of action to protect both banks and their customers in the years to come.